Welcome to our live stream about the Bank of England's monetary policy decision. And let me just start off by saying what I'm going to do, and then we'll have questions at the end, obviously, as we usually do. And try to keep the questions about monetary policy because we have live streams where we talk about finance generally at other times. So let's start off with what happened. And pretty much as markets expected, what happened was that the policy rate was kept at 5.25%, so no change there. And it wasn't a unanimous vote, unlike the Fed's decision, which was unanimous in the latest press conference from the Fed. So this was a vote 7-2 to keep rates unchanged at 5.25. The two people who wanted to have a cut was the deputy governor, so that's Dave Ramsden, and Swati Dhingra. So those are the two people that wanted to have a cut. The rest of them were happy with the decision to keep it where it is, the 5.25% rate. The market reaction, initially sterling weakened quite a bit, but then it kind of recovered. Markets were pricing in a 50-50 chance of a move in June, and that's really only slightly moved forward. So it's still 50-50 in June. And the cuts through 2024, so that's all of the interest rate cuts priced in for this year, are still about 60 basis points, 59, 60 basis points, so 0.6%. So that's about 2 and a bit rate cuts between now and the end of this year. Previously it was 54 basis points, so a tiny increase in the number of rate cuts. It's interesting, if you look at the coverage in the news, a lot of people are saying this was a kind of dovish meeting in which they were talking about finally cutting interest rates. I didn't see that, and it looks like markets didn't see any extra information about that either. But generally, the story was one of slightly stronger than expected economic growth, so they upgraded their growth forecast slightly. Inflation was downgraded slightly, so a bit lower than they expected previously in February. And they did kind of hint that there'd be policy cuts later, but they were very keen to say that in June, it's still a live meeting. It could go either way, because they always say that. They're never going to actually tell you what they're going to do. So that's the overall story. And there's obviously been progress with inflation, which is a positive. Wage growth still stays strong. But the good news, I guess, from the point of view of people in the UK is that there are rate cuts in sight. That hasn't cut mortgage rates. In fact, mortgage rates have gone the other way. Not so good. For borrowers, it's good news because interest rates are staying high for a relatively long time, I'd say. But unemployment isn't expected to pick up a lot. So if you're worried about job security, it's reassuring to hear that, there's still, they do expect unemployment to increase slightly, but not a lot, not as much as they did previously. So that's the kind of gist of it. And then we'll go through now some of the details which we can dig into. So I'll share here and we'll begin. So this is the tweet that came out from the Bank of England today, and it just kind of highlights the decision. They voted 7-2 to maintain the rate, and yes, they need to make sure inflation comes down to 2% and stays there. And this is their forecast for inflation. Now, of course, it's still above the 2% target. That's still true. But they are expecting by Q4, it's going to start moving down to their target. It will be at their target, they expect, the bank, by the second quarter of this year. Then it'll increase again to Q2 of 2025 when it'll peak, and then back to the target, just below, in fact, in 2026. But then notice that by 2027, Q2 of 2027, it's below target. So this is one of the reasons why people said that the Bank of England looked dovish, because according to their own inflation forecast, will be below target by 2027. And if that's the case, then that seems to be that's going to push them towards reducing interest rates sooner. So that was the kind of dovish part of the story. And then if we look at the history of bank rate going back to 2002, you can see that it's been restrictive, very restrictive for some time now. And obviously it's likely to stay that way probably, in my opinion, past June. Looking at it over a longer period of time, so if we go back to 1694, you can see that actually 5% is completely normal. That's been the bank rate that we've seen for a very long period of time. That's been the median bank rate since 1900, and more recently still, we've had this very low period of interest rates, but that was very unusual. Now we've just gone back to normal, although the terminal rate will probably be, if it's anything like the US, something like 3%. This is the sequence of, if we zoom in, these are the sequence of very rapid rate increases, and we've been kind of hovering up here at 5.25% for some time now. So now let's talk about the inflation rate, because that's what it's all about. Of course, that's what the Bank of England's trying to control. The latest print for headline inflation is 3.2%. So that is falling very rapidly. We are seeing very, very clear disinflation, and core inflation, which is what the Bank of England pays more attention to because it's more predictable, it's a better predictor of future inflation, and that's not falling as quickly, but it is falling, which is great news. So that's down to 4.2%, and then headline is 3.2%. And if we look at the changes, the drivers of the changes over the period between February and March, these are the things which moved it down. You can see that most of the components are negative. So all of these components, 6 components out of the 12, were actually dragging inflation down. Food and non-alcoholic beverages, furniture and household goods, clothing and footwear, restaurants and hotels. But then what's pushing it up is communication and transport and household services. So energy, which came via housing and household services and transport, was pushing inflation down. Now that's stopped, or at least slowed down. Now it's moved into the other sectors. But that's what's pushed inflation down between February and March. And if we compare the UK with the rest of G7, the other developed economies, the UK is still out in the lead in terms of inflation. The EU average is 2.8%, we're at 3.2%. France is even lower, 2.4%. Germany 2.3%, and the US, if you use an equivalent measure, which is hiccup, only 2.2%. So it's still the case that inflation's higher than the rest of the world, the rest of the developed world, but we are clearly catching up with the rest of the world, which is reassuring. So now let's quickly go through the kind of press conference, and I'll just summarise what my take home was from it. I'll just cover the key points here. So I think one of the points which was kind of interesting, which Bailey was making, was that one of the signs of normalisation is that there were fewer data surprises. Now, during the pandemic, the post-pandemic period, it was all surprises. And the forecasts from the Bank of England were just way out, but so were every other forecast from every other central bank across the world. None of them accurately predicted the huge surge we saw in inflation following the switching back on of the economy after lockdowns ended. But now what we're seeing is closer outturns, as they call it, reality, compared with their forecast, which is good news for them because it means they've got a better handle on which way inflation's moving, and their policy can adjust much more accurately to what's actually going on. And inflation's at its lowest rate since December 2021. Again, that's encouraging. 12-month CPI inflation fell from 4% in December to 3.2% in February to 3.2% in March. And so that's good news. And overall, they think it's going to edge up again in the second half of the year. and that's because negative contributions from energy prices are going to fade. And another interesting thing was that wage growth and services inflation, which is, remember, what's causing UK inflation to be sticky, that's been a little higher than they expected in February. And now, if you listen to what the Federal Reserve said, they just dismissed the previous 3 prints of inflation as being bumps in the road. But then this latest meeting, they said, well, actually, it really does look like inflation's going up again. Whereas the Bank of England is still in bumpy mode. They're still saying that inflation and wage growth have both been a little higher than we expected in February, and that'll give us pause for thought, is the way Bailey put it. But he said we should not overinterpret these surprises either. There will always be some ups and downs on the data. So maybe it's just volatility, he could be right. But personally, I think that it's part of a broader trend, which is the easy wins are gone, and now we're going to have this long, sticky tail of inflation. At least that's the way it seems. So one of the other things that they stressed is before their next meeting, this is the one in June, they're going to have 2 full sets of data for inflation activity and the labour market. So that's going to be, could completely change the story between now and June. And his point was that the change in bank rates in June is neither ruled out nor a fait accompli, which he said, this is what Bailey said about June. So June is still a hot meeting. They've still got the possibility of changing their minds, and there's going to be a lot of data that they're going to have to digest between now and then. So one of the things that the bank produces are key judgments. So they take this huge amount of economic data, and their economists help them to come up and boil it down to some key points. And there are 3 key judgments which they've come up with for this meeting and for this monetary policy report. The first one is that GDP growth is expected to pick up during the forecast period, which is over the next 3 years, 2 to 3 years. And of course, it was weak at the end of last year, but now they're expecting it to pick up. So that's good news. The second point is that demand is going to gradually fall, and that's largely because of monetary policy, they say. So they're having a damping effect on economic activity and demand for goods and services in the UK. And that's by design, of course. That's how they get inflation to come down. So essentially what they're saying is that their monetary policy is working. The third point was that second round effects, and this was the one which was interesting, second round effects in domestic prices and wages will take longer to unwind than they did to emerge. What does that mean? Well, the point is that let's imagine you're an average UK worker or an average UK business. We've just gone through this huge spike in prices. That means that you're effectively poorer. So if you got a wage increase, or if you put up your prices as a company, even though your inflation rate is falling, you'll still keep your demands for higher wages longer because you have to recoup those lost earnings in real terms. And that's true for businesses and people. And they're saying that's what they call a second round effect. And apparently there was a lot of disagreement within the MPC, the Monetary Policy Committee, about that third point. And it's really important because that's what determines the stickiness of inflation. So if there are strong second round effects, then it's going to take a long time for inflation to fall. And it is the case, as we saw, that the UK is taking longer to fall back to 2% inflation than other countries. And it may be these stronger second round effects in the UK which are causing that. So there was a little bit of disagreement. Here we go. So there remains considerable uncertainty around this judgment, however, and I should note that MPC members do hold a range of views about it. In other words, they had a ding-dong about the stickiness point. But he says that as households and businesses understandably sought to resist an erosion of their real income and profits. So then he makes the point that real incomes are now growing again, and that might reduce the demands for higher wages later on. So maybe we will see those wage demands start to fall, and we'll see data on that shortly. I've got a nice graph of that. And his point was that aggregate real income growth, that's above inflation, is as strong now as at any point over the past decade. But again, let's look at some data on that just to see the longer term context. See if there's anything else I wanted to add. Yes, monetary policy. So here's the point, here's the sentence which got people excited about monetary policy. It's likely that we'll need to cut bank rates over the coming quarters and make monetary policy somewhat less restrictive over the forecast period, 2 years-ish, possibly more so than currently priced into market rates. So if you look at market expectations based on swap rates, he's saying that this 50-50 rate cut, maybe in June, maybe the one in August, is not sufficiently dovish. That markets think that rates will be higher for longer and for too long, compared to what the Bank of England thinks. And he makes his secondary point, which is this would be consistent with ensuring that inflation does not fall noticeably below target at the end point of the forecast. Because monetary policy acts with a lag, they're currently forecasting that in 2027 will be below target. So they've got to take their foot off the accelerator and cut rates before they reach that 2% target. So it is looking imminent, certainly for some of the committee members. So I think that kind of summarizes his intro to the beginning of the press conference, Bailey's introduction. This is kind of interesting. This is the forecast that they came up with in the monetary policy report, which they've just published. And what's interesting about this is the numbers in brackets, in parentheses, are the forecast from February, and the numbers next to it are the current forecast. So notice how GDP growth has been forecast up slightly. Previously we were bumping along above zero slightly. Now we're bumping along a little bit higher than we were. Inflation's been, well, Q2 is the same, but for Q2 2025 and 26, it's actually been reduced slightly. So inflation's less than they expected in February. And the unemployment rate will now peak, instead of being at 5%, it's going to peak at 4.8. So yes, that means hundreds of thousands of jobs won't be cut that they were expecting would be cut. So that's good news for workers. And then if you look at the bank rate, that's been revised upwards. So because inflation was stickier than expected, and this is true of any developed market central bank, markets have revised up their expectations of where the policy rate will be. And that's true of the Bank of England, it's true of the Fed, it's true of the ECB. That sticky inflation has affected almost every market. And it's always services inflation that's stickier than expected. And that's the point they're making in this graph, which is chart 2.7 from the report, where they show what the expectations were from markets. So this is probably from the swap rate, from the OIS market, OIS swaps. So the dashed lines are what markets were expecting in February, I guess. And then the solid lines are what they're expecting now. So both in the US, it's been upgraded. So they think rates will be higher for longer. Same for the UK, that's also higher. And for the Euro area too, although to a smaller degree. So, this kind of stickier inflation, higher for longer, is a narrative that's true across all of the major central banks, except for Japan, of course. Now, the thing that most people care about is, how's this going to affect my house price? And we have had this flat period of house prices pretty much since the beginning of 2022. House prices have almost gone nowhere. And if you adjust for inflation, they've gone down considerably. And that is starting to improve according to Rightmove. So Rightmove is the one survey which is showing an uptick. And maybe Halifax as well, but the nationwide house price index looks pretty flat to me. But it is starting to maybe stabilise, maybe improve as interest rates were dropping. But as we'll see, if we actually scoot forward, I've got a nice mortgage rate graph here. You can see that while rates were starting to fall, what's happened recently over the last month or so is that the rates on the average 2-year fixed mortgage have increased. And that's really bad news. If someone was kind of delaying fixing their mortgage, waiting for it to fall a bit further, or delaying their remortgaging, expecting the rates would fall, it must be disheartening to see that increase again. Personally, my guess would be that this is temporary. And as inflation starts to improve and it looks like the bank is going to cut rates, and it will eventually, then that'll start to fall again. But certainly if you look at the swap market, the interest rate swap market, that really wasn't moved by today's meeting at all. And that's what drives mortgage rates. So the fact that that's gone up is kind of not good news for house buyers who are borrowing to buy, which makes up about a third of households in the UK. If we go back to the data here, this is my point about wage growth. So yes, wage growth currently is real. So if you look at the total pay growth, the most recent data from February shows 5.5% increase in wages year on year, whereas inflation was only 3.2. So we've got a real wage growth of about 2 percentage points, which is good news for a worker. So here it is, total pay 1.8% real. However, it's still the case that if you look at previous average wages, we're roughly where we were 16 years ago. In other words, there's been almost 2 decades in the UK where workers have not seen an increase in their salaries. Just think about that. It's very unusual for any developed market to see that since World War II, and yet that's what we see in the UK. So it is very disappointing, and it must be very difficult for young people in particular who tend to see the highest wage increases just to see that stagnation and to see their quality of life being worse than that of their parents, probably. So I think that's a real problem in the UK. It's not a problem from the Bank of England's point of view. They didn't cause the problem. It's hard to know how to fix it. I think it's politicians who have to effectively take us out of this funk in terms of wage growth. And unfortunately, there are no quick solutions. How do you get people to be paid more in your country? Well, education, a shift in the industries that they operate in. We do lots of services. We're very good at services. So somehow boosting that perhaps would be the way to do this and export those services more effectively. Having better trade agreements would certainly help in order to export those services. But other than that, it's very difficult to quickly turn that around and to kickstart wage growth. The inflation bit, which is sticky, is services. So services inflation is currently 6%. And as you can see, it's hardly fallen from its peak, which was about 7.5. Whereas if you look at goods inflation, it's below that 2% target for the Bank of England. So goods are going in the right direction. Prices aren't rising anywhere near as quickly. There's huge disinflation for goods as the bottlenecks in supply have eased and demand has eased as well. But services is still a big problem for the UK. And that's not just for the UK, it's true for other countries around the world. It's true in the Euro area, it's true in the US, as well as the UK. So it's services inflation that's a real problem. And then one last point, I guess, is about the tight labour market. So the point here is that inflation has ticked up in the UK to 4.2%, but it's been, what am I talking about? Unemployment ticked up to 4.2%, but it's still very low by historic standards. It's still lower than it's been since the 70s. So that, if you went back to the 70s, we'd have an unemployment rate roughly where we are today. So that's a pretty tight labour market. And if we look at the UK vacancy rate per unemployed person, This is currently 0.64, so that's roughly where we were pre-pandemic. But again, that's pretty high by historic standards. So if there are lots of vacancies for every unemployed person, that suggests that the labour market is still pretty tight. That suggests that wage inflation can carry on being very brisk. The argument being that if you can easily walk out of your current role into another one, you'll be able to negotiate a much stronger wage as a result. So yeah, it does look like it's going to stay sticky for a while until this normalises further. But it has come a long way, as you can see, from something like 1 vacancy per unemployed person down to 0.64. But it's still not quite down to where we were over the period since 2000 on average. And that kind of brings me to the end of those bits when we were looking at the data together. So at this point, I'm going to summon my dog and I'm going to give him some treats, some stinky treats, and you can get your questions together and then I'll answer those questions. So I expect to hear thundering paws at any moment. Laura will hear what I just said about now. Here he comes. Here's my treat ready. Fine bouquet. Oof. Oh God, it's like smelling salts. How can you eat these? You love them. So you're going to have another one before you go down for your biltong, because that's what he does. Shall I get him to do a trick? Right, we're going to do the standing trick. You ready? Okay, stand. Oh, don't touch me. Oh, good boy. Oh, you clever lad. There we go. You're going to go back down? There's biltong downstairs. I just bought you a whole new bag of biltong from the Amish and Biltong shop, which isn't sponsoring tonight's live stream. Go on, Laura. You're going to go down to Laura. He's just kind of doing his cockapoo. It's very cute. Oh, here we go. Brilliant. So let's see if we can answer some questions. Yeah, so please do like and subscribe. Please do super chats, because obviously that helps us financially and will push your question to the front of the queue. And if you're one of our supporters on YouTube, also will push your question to the front of the queue. But usually we go through some of the questions from people who aren't supporters as well. And I'm going to have a drink. Let's have a look. Oh, Tom's Personal Finance. Hello. Nice to see you there. Yeah, lagging indicators. So there's a question from Mark Blackmore who says, I'd love to hear if you agree with Sashi Janssen about lagging indicators, that these are incorrectly causing too much caution against lowering rates. The thing is, the Bank of England is well aware that their policy operates with a lag. No one can agree on what the lag is, but they're certainly aware of it. In fact, if you listen to any press conference, they always talk about long and variable lags, right? That's always the case. Certainly they talk about the lag. But is that what's stopping them from cutting interest rates? I don't think so. I mean, if you listen to what Bailey said today, the real disagreement was about the second round effects of inflation, because that's it's difficult to pin that down with data. Are people demanding wages stay high, wage growth stays high, to compensate for their losses as inflation's eroded their income through the spike period? And is that's what's keeping inflation high, particularly in services, is that wage growth. So, is that real? Is that effect real? That was the big debate in the kind of according to the Bank of England, at least according to their press conference and what Bailey said. And you can see why that would be a difficult thing to quantify. I mean, how do you know? It's very difficult to kind of pin that down with hard economic data. There was an interesting thing, which was the agents survey about that, actually. Let's see if I can find the agent survey thing. That was interesting. Yeah, here we go. So this is a slightly different point, but I just thought I'd share this because it's kind of interesting. Because what the Bank of England does, I don't know if you know the stories about, when there's a king just before a war, a battle, sometimes they take off their robes and they kind of walk around their troops just to get a feel for the mood of their troops. And they go incognito, and this happens in Shakespeare plays, for example. And the Bank of England equivalent of that is their so-called regional agents. So they speak to people who are kind of embedded across the country and ask what they're seeing in the real world, so that they can calibrate their understanding of what's going on in the UK economy. Because if you just look at economic data, it's very dry, it's difficult to work out what's going on. Sometimes you do need these kind of anecdotal pieces of evidence. And if you look at the agents survey, what they're showing, one of the things that they're showing is that consumer spending has weakened more sharply than expected. And this is widespread across the services sector. So people are spending less in the UK. And you can kind of see that if you just kind of look around. I certainly feel it. And I certainly hear this from the shopkeepers that I speak to as well, is that people are kind of cutting back on their expenditure. And also when I speak to people in power hours, one-to-one coaching sessions, this is what they tell me too, that people are cutting back. Supermarkets see growth due to discounts. So the way to get ahead is to offer cut prices, and falling trade at pubs and restaurants. So that suggests that people are cutting back and being more careful, perhaps because they're worried about unemployment, perhaps because they're just poorer and it's expensive to service their mortgage, it's expensive to service their debt, and the wages aren't keeping up with their expenses in some cases. Although, as we saw in aggregate, wage growth is higher than inflation. Investment intentions have fallen back. That's not good news from companies, because that means they're spending less, and that usually slows down growth further down the road. And that's partly due to high costs and a dim outlook for demand. So all of this kind of feeds into each other. Export volumes continue to fall, but there's modest positive growth later this year. That's the expectation. Demand from the US and Middle East are robust. Weakness from China, maybe due to politics, but also from the EU. Well, that's self-inflicted. Manufacturing and construction are declining, and business services are flat. So, the one kind of saving grace is that at least business services are not falling, because that's so important for the UK. But the good news is that confidence is gradually returning to the housing market, but that's not translating into higher sales yet. Okay, so that's the kind of summary. But that kind of leads on from your point about lagging indicators, because the Bank of England has access to a lot of information that we don't have. And that's why I think it's important to read these reports and to understand what the bank's doing, because they act as a kind of nexus for so much economic information. If you really want to know what's going on in the UK economy, they're a pretty good source of that information as just a random retail investor like me, rather than someone who has access to proprietary data. So I think they're a very good source of that information. But do I think that they're not cutting because of lagged data? No. I think they're fully aware of that. And I think they have access to so much information about inflation, about wages, about the structure of the UK employment market. I don't think that they're kind of bereft of data. I think one of the problems is that the survey from the ONS and the labour force survey, and this was one of the other points that they made in the MPC report, the labour force survey has just been updated and it's giving some really weird and contradictory readings, which is pretty worrying because the Bank of England, of course, has to look at unemployment data, and that's where it comes from. It's the ONS. So they've just changed their methodology as the response rates in their surveys was falling to dangerously low levels, and so low, in fact, that it wasn't reliable following the pandemic, and it never really fully recovered. So they've got to come up with a new methodology to gauge unemployment and demand for workers. So that's worrying in terms of indicators that they look at, but I think the lags isn't the problem. That's not the source of the problem. Hi, Amir Ketobji, nice to see you again. That's lovely to see a regular face, and thank you for the super chat. That's awesome. He also has a question today. He says, what can UK investors expect from a Labour government, and what to do to mitigate the risks? Keep up the good work, he says. Okay, I'll try. So what can we expect from a Labour government? Well, there are certain policy statements for investors which we kind of know are true. There are some we kind of suspect, but probably aren't true. I think the big one is the lifetime allowance. So if you're going to top like £1 million, that was going to be scrapped by the Conservatives. It's looking likely it'll be reinstated by Labour. Frankly, it doesn't affect that many people. It affects quite a few pension crafters, I have to say, because they're probably on average much wealthier than the average person in the UK because they're investors. So it's a kind of self-selected group. So certainly within our community, people are worried that there will be a reinstatement of this lifetime allowance. So people are talking about spending the money or somehow avoiding this, the impact of this lifetime allowance. Personally, I think that's not a bad thing because they're reinstating it, because frankly, once you're up to that point in terms of wealth, then paying a little bit more tax is not that bad. I think it's kind of acceptable. Remember that all it means is that you pay more tax. You don't get the wealth confiscated. It's not like that. It's just that you'll be taxed at a higher rate on income or on wealth above that 1 million. So it does increase your tax rate. But I think that's kind of okay. It's already super generous in the UK. We've got ISAs, we've got SIPs. One of the things which I've seen hinted at, because it was in a resolution foundation report, was about capping ISAs. Now remember, the way ISAs work, the individual savings accounts, is you can put £20,000 of new money in every tax year, and you can split it almost any way you like now. You can open more than one of the same type of ISA, stocks and shares. Now, you couldn't do that previously, but there's no upper limit on the amount that's invested. You obviously, once it's in an ISA, you can sell things, buy things. As long as it stays in the wrapper, you never pay capital gains or interest or income tax on that money ever again. That's the idea. There was a hint by the Resolution Foundation, or their suggestion, their policy suggestion, was that you set a £100,000 cap on ISAs. So that's on the total amount, not the amount of money you can put in. Because previously, if you put in, say, 20 years of contributions into equity markets, you could pretty easily reach £1 million in your ISA. And that money would be free of income tax and free of capital gains tax forever. Now, if you actually look at the amount of money that saves, that it costs, the ISA amounts, I actually worked it out. I think it was 0.4. Is that from me? No. Yeah, UK tax trillion. Here we go. So if you look at the amount of taxes which the UK raised in 2023, so that was the 22-23 tax year, it was just over £1 trillion. It was 1.029 billion. 1.029 trillion. Sorry, 1.029 trillion. And according to this Resolution Foundation article, which was called ISA Baby, they suggest having a 100k cap, and they say that the tax lost in each tax year due to ISAs is about £7 billion. Now, as a percentage of total tax revenue, that's only 0.7%. So frankly, it's not even moving the needle in terms of tax take. But I think it's more kind of playing to the politics of envy if people put that cap back in place, because it's certainly not going to make much difference to the tax income that Labour would have. But, you know, I think if they did do that, there'd be a lot of pushback. I think the easy one to do would be the 1 million for SIPs, because that's kind of more reasonable, I think. But stopping the UK from saving in ISAs, I think, is a big mistake, because eventually that means that they'll have more money that they can use in retirement, and they'll be less dependent on kind of public services, or on they'll be able to be less. They can be more independent, put it this way, in retirement if they save more. And we're already one of the lowest savers in G7 in the UK. So encouraging saving, I think, is a good thing. But would I be cutting my ISA contributions as a result? No. I'm way off the £1 million limit anyway for my SIP. But PensionCraft is doing pretty well, I have to say. You know, we've been growing our membership a lot recently, and so the income's gone up a lot. But you know, I'm way off the £1 million. So, you know, I think it's kind of fairer, the SIP cap, lifetime allowance. But other than that, you know, I can't see that Labour would try and kibosh the economy. I think they're drawing a line under that kind of old Labour behaviour. But we'll just have to see. You know, once people get into power, the story changes quite a lot often. So we'll just have to see if that's the case this time around. All of these policy things are very likely to change, depending on what economic growth is. They haven't really got much leeway, so anything which slows down growth or doesn't encourage more growth, I think that's more of an issue for Labour when they enter power than tweaking these tax rates for savings products. I think that's unlikely to be on their radar for some time. So let me switch back to you and your questions. How are we doing for time? Well, let's give it another 15 minutes, and as I'll answer as many questions as I can in that time. Okay, somebody says, yeah, okay, so there was one about personal savings allowance, one about Nancy Diaz says good doggo. He is a very good dog, Nancy. I love him very much. So does Laura. Lewis says, how are the base rate changes predicted to depress yields in the money market funds? Will it have an impact on dog treat prices? Yes. You would not believe how much it costs. Every bag of food, 12 kilogram bag of food for Ted, it cost me 80 quid. And then, you know, the treats, I buy lots of these treats. I think it's like £5 a bag, the treats. So, yeah, it's not cheap. But, you know, I love him, so I wouldn't, you know, I'd rather go hungry than not have him eat. But base rate changes. So if the Bank of England cuts its base rate, bank rate, we call it in the UK, then is that going to lower income for money market funds? Short answer, yes. They actually track another rate, which is called SONIA, the Sterling Overnight Index Average, but that pretty closely tracks bank rate. So it's almost certain that once they start to cut rates, probably even before, those money market rates will start to fall. But look, is it going to fall rapidly, and is it going to be a kind of sequence of big cuts in the interest rate? I don't think so. I think they'll probably be quite careful, because what they don't want to do is to cut rates too quickly and then have inflation surge again. You know, that's going to be counterproductive and also make them look silly. and less credible. So I think they will cut. All it means is that instead of earning 5.2% on your money market fund, you'll earn 4.95. And then next cut, you're going to earn 4.7. So it's going to go down in 0.25% increments. I doubt they'll do 50 basis point cuts because that would be destabilizing probably. It just depends on how bad the unemployment rate is. If unemployment got really bad, then they could cut faster. But I suspect that's not going to happen. That's not my belief anyway. So all it means is that you'll earn slightly lower rates with your money market funds, and the rate of growth will slow down over time gradually. But at that point, what you could do is you could go further out on the yield curve, either buy a bond fund which has longer maturity, or the way I do it probably is to buy longer dated gilts, because those will lock in a higher rate for longer. And if we go back to an upward sloping yield curve, let's switch the yield curve, PensionCraft.com. And so if you're one of our premium members, one of the things that you get is this funky yield curve graph. And this is what it looks like. So this is your dashboard. So if you're a member of our community, this is your kind of launching point for our website. And the trackers are over here. So we launch the trackers and we'd go to Macroeconomic. Got a whole bunch of them. And the one we want is the yield curve. So I'll make myself a bit smaller there. Over here. There we go. So UK yield curve. And we've also got it in the form of a table here. But let's look at the yield curve first of all. So what I'd expect to happen is that the short-term yields here, which are driven pretty much by the Bank of England, this will move down. So it'll move down to about 3 eventually. And then the long end of the curve, which is driven by growth and inflation expectations, so that's GDP growth and UK inflation, that'll probably stay roughly where it is, maybe move up a bit if growth expectations improve, which could happen, you never know. So what overall will happen is that this inverted shape will start to normalize, but it'll be the long end which stays fixed pretty much, and the short end which moves down. So that means if you buy bonds further along the curve here, you're getting a pickup in yield further out on the curve. And that way you can earn more yield. At the moment, having more duration risk as you extend the maturity of the bonds you buy reduces your yield. So you're being paid less to take more risk, which is pretty odd and pretty crazy. So money market funds still make absolute sense, I think, because this is going to move down slowly and you'll have plenty of time to lock in a better yield with a gilt curve, with a yield curve. And another way to look at this is as a kind of table. So if you're holding large amounts of cash outside an ISA or a SIP, and you can cap this, I don't know, 0.8. So I can filter the outstanding gilts based on coupon, and if I cap that at 0.8, then all of these are fairly low coupon gilts where most of the return is going to come from capital gain, which is not taxed for UK gilts. So a lot of our pension crafters are buying these low coupon gilts in order to reduce the taxes they pay on their holdings outside their ISA and their SIP. And then as each bond matures, you can park a bit more of it in an ISA, a bit more of it in your SIP and that of your partner. The bit that's left over, you just reinvest in another bond. So very safe investments. You hold them to maturity and don't worry about mark-to-market losses. And very capital gains efficient because you don't pay capital gains tax on them. So yeah, that's been popular with our members recently. So lots of questions about buying gilts. I've had that kind of flare up again recently, and it's probably because the Bank of England's talking about cutting rates at last. Oh, we've got another super chat. Thank you. And even better, the person is called Concon MCMC. Is that Markov Chain Monte Carlo by any chance? And there's a lovely picture, I think, of a Jack Russell, possibly a Staffy. So love dogs, so that's good. Anyway, the question, the super chat, thank you ConCon, MCMC. Hi Ramin, wondering if you could do a video on leading indicators for stock market performance and if they actually exist or not, like 10-year yield US. Have done that actually already. I did a video for members about macroeconomic indicators. I don't think I did it for YouTube. Maybe I did, but I don't think I did. Certainly I did one for members. And there are lots of good books on this. For example, this one's not bad. So this is a book I've had for ages actually. It's called Wall Street Journal Guide to 50 Economic Indicators That Really Matter. Now, do they really matter? Probably not. But things like PMI indices are interesting. The Bank of England was talking about the PMI indices as a leading indicator for the UK economy. But the trouble is always that even if you could predict GDP, it doesn't mean you can predict what's going to happen in markets. And there's a very weak linkage between, in fact, there's a negative correlation between GDP growth and equity returns. So even if you could predict the economy, and that's what leading indicators do, you probably couldn't predict markets. There is something you can watch, which is credit markets, because firstly they adjust very quickly. So if you can measure credit spreads and you can get free credit spreads out of Fred for the US, then what you have is a kind of real-time indicator of credit stress. And if there's stress in the credit market and spreads are widening, usually it feeds into the stock market about 6 months later. 6 months, 9 months, something like that. So in that sense, credit markets in the US and elsewhere probably are a canary in the coal mine for the equity market. So if they are going to turn south, often the credit market turns south before the equity market. And so maybe that's one thing you could look at. But the yield curve, not particularly useful. You can't even forecast recessions. The latest, we've had a yield curve inversion in the US for a long time now with no signs of a recession, at least not yet. Maybe it's just delayed. But usually, any kind of reasonable lag, and we should already be in a recession, but we're not in the US. But there is no kind of secret source, of course. If there was, then it would be priced into markets very quickly. Spluga says, I love Bubby. He's called Teddy. But it's very nice that you call him that. It's kind of cute. Yes, so let's answer some more questions. We've got 7 minutes. My self-imposed deadline of 7 o'clock. Let's see. Let's see if we've got any other super chats. No. Okay. Okay. Orun says, I want rates to stay high so I can keep buying the dip on UK-US REITs. There we go. So that's the kind of right attitude, which is look at what high interest rates are depressing, realise that that's temporary, possibly, and when rates start to fall, they should recover. Now, the problem here is that some of the changes in REITs are more to do with changes in behaviour. So working at home, not working in the office. So office space clearly is more of a kind of behavioural change, I'd say, than to do with interest rates necessarily. But other parts of the commercial real estate market are very rate dependent, so I think that's a good idea. I like that, Orun. Eddie Ward says, do they have a crystal ball? I think that's a rhetorical question. And Eddie Ward also says, that's criminal. No wage growth for 16 years. It is terrible. It is awful. And I think there's a little bit of a kind of drawbridge mentality here for older people where, you've achieved success in your career, you've got a reasonable amount of wealth. And I think we could do more for younger people in the UK to try and, pull them up with us. Education's one way to do that, but another way perhaps is you know, a better minimum wage if they're really at the bottom of the wage distribution. Better employment practices. I don't know how you could do it, but we've got to do something to try and get the average person paid more in the UK. It's the kind of work they do, obviously, that matters. So if we could somehow provide more services, you know, get more people working in the service industry, exporting that across the world, you know, that would be good. I think trying to flog the manufacturing horse may not be the way to do it. That's not what we're particularly good at. Banking, we're very good at banking, but we hate the banking industry for some reason. That's a problem. You know, why would you hate something you're good at? It's kind of crazy. But that was one of the benefits of Brexit, which is that bankers' bonuses are now no longer capped. So that's a big win. I'm not a banker anymore, so that was sarcastic. Cheap food, a thing of the past? Again, Eddie. Interesting question. Monty Load says, does the employment data include those on no-hour contracts? To be honest, I don't know. I don't know how that would work. I think the labour force survey might include those people, but to be honest, I don't know. I'd have to look into that. But that's a really interesting question. Gavin Lawrence, smelling salts? Yes. Double as smelling salts. God, they smell awful. Wench says, 4 minutes. Wench says, is it really financially sensible to buy a house when investing that money instead will more than pay for rent? Yeah, I mean, economically, you're probably better off investing in the stock market and not buying a house, renting. But of course, if you don't like the instability of potentially being moved on by your landlord at any point and not owning the property you live in, some people find that very psychologically disturbing, you know, being able to, having to uproot and kind of move somewhere else, not by your choice, but by the landlord's choice. And if you've got a nasty landlord, you know, in the past I've been lucky when I did rent. We had a lovely landlord when we lived in Amersham, Laura and I, lovely guy. But if you're listening, Andy, hi. But, you know, you can be unlucky with the landlord. And some landlords are pretty awful by the sound of it. You know, mould, poorly kept property, very high energy bills, no maintenance done for a long period of time. So, yeah, I can see it can be a problem if you're renting. And at least if you own your own house, well, it's up to you whether you let it fall apart. But, yeah, economically, you're better off usually in the stock market, simply because the return on equity long term is more than the return on the house you live in. Buy to let, on the other hand, is a different story, and I've done a video on this recently, because there you have an income generated by the house, of course. That's why you have buy to let, and that income massively changes the economics, because then it actually looks more comparable. And in fact, there's a paper called The Return on Everything from 1800 to 2015, but that looks at centuries of data, or at least when that's available, and it compares the stock market with buy-to-let, effectively, across multiple countries. And there isn't much between them, and that's because of the extra income you get from buy-to-let. The house you live in, the cost of carry is negative, because you have to maintain the house, and that's a cost. It doesn't generate an income. So you're always talking about, you know, if I paid rent, you know, what would be the comparable rent and how am I better off that way? But buy to let, yeah, as an investment, it diversifies your equity. It has drawbacks. It's very illiquid. It's geographically concentrated. You have to put huge amounts of capital into it. It's very tax inefficient. You know, there are lots of drawbacks, but certainly the return on buy-to-lets is comparable. But the house you live in, usually you're better off renting economically than and then investing the money in the stock market. That's true. There's pretty strong evidence for that. Will falling percentage rates, interest rates, give a new UK government more room to borrow in the next Parliament? Yes, and no. And the reason why I say that is because if you actually look at the yield curve, and I'll just refresh that and maximise that, look at it. So back to the UK yield curve. The point is that the Bank of England controls this bit of the curve. So when Andrew Bailey cuts rates, the MPC cuts rates, it's the short end that's going to move down. The long end is not that correlated with the short end. The correlation falls off quite quickly. So this end of the curve is much more driven by growth and inflation expectations. So the best thing that the government could do to reduce their cost of borrowing, certainly for the short end, is, the Bank of England can do that. So if they borrow more at the short end of the curve, once the bank starts to cut rates, then that would reduce their cost of borrowing. In the UK, on the other hand, what usually happens is we tend to borrow at the longer end of the curve. So maybe what the Bank of England should do, what the Treasury should do, the Debt Management Office, is issue more debt at the short end of the curve, because that'll pick up the lower rates as the Bank of England cuts. Maybe that's their policy, that's the way they should do it. And I think there'd be appetite for the debt, so I think that would make sense. But historically, we've just been a market where we issue more long-dated debt because the natural buyers of that debt has historically been companies like pension funds, life insurers, who like to buy lots of duration, really long-dated debt. So it's been a readily available, readily marketable product if you sell long-dated debt in the UK. What I've seen, certainly in PensionCraft, is an astonishing increase in the interest in buying UK gilts, partly because of the tax treatment, partly because interest rates are now higher. So I think you can market that stuff to retail investors much more easily now. And they've started to make it available to people in the primary market. So once they have an auction for this debt, I could apply on Interactive Investor to buy some of the debt in the auction in the primary market. Previously, you could only buy it in the secondary market. You could buy the bond from somebody else once it was issued. So clearly the market, the government, the Debt Management Office is moving more towards selling its debt to retail investors, but it is a slow process. And I suspect the uptake won't be as high as it is in the US, for example. But I think that's the way to go. I think it makes a lot of sense for people in a country to buy the government's debt, because it is low risk in the UK and the yields can be considerable. And it certainly fills a niche, I think, for the average investor, for short-term, low-risk stuff. Anyway, so I think we've reached our self-imposed deadline, and so we'll draw a line under it there. Please do like and subscribe. Please do tell other people about PensionCraft. Remember, you can do one-to-one with me. Go to our website, PensionCraft.com, to learn more about that. We can have a wonderful hour together, and we can discuss investment. No advice, of course, just education, but those are quite popular. Oh, we've got another question. Oh, no, we haven't. Matt did a super chat, and he's put £2 towards Teddy's Biltong fund. Awesome. Teddy loves you. So please do like and subscribe, and we'll speak again soon. Please do join our community. Just go to pensioncraft.com/membership to learn more about that. And thank you for joining us. And fingers crossed, here's to the Bank of England's rate cuts happening later this year. Take care, everyone.